Okay, I'm getting ready. Got it. I'm getting ready to start the webinar.
Okay. Delta Sigma Theta Sorority Incorporated is a private, not-for-profit organization whose purpose is to provide assistance and support through established programs in the local communities throughout the world. The Suburban Houston Fort Bend Alumnae Chapter was chartered on May 22nd, 1976 as the 553rd chapter of Delta Sigma Theta Sorority Incorporated. Their new service area includes Missouri City and Fort Bend County. The chapter's current president is Jackie D. Smith. Greetings and welcome to the first webinar in our Lunch and Learn entitled Investing 101 The Basics. I am Brianna Campbell, member of the Suburban Houston Fort Bend Alumnae Chapter of Delta Sigma Theta Sorority Incorporated. This webinar is being presented to you by the Economic Development Subcommittee of Program Planning and Development. Now, before we get started, if you haven't already done so, grab your lunch, get you a notepad, and get ready to learn some great information to help get you started on your journey to investing. And now I will turn the program over to Paula Suggs, another chapter member, to introduce our guest speaker.
I am so excited today to present our guest speaker. Mr. James Boston is a private wealth advisor and managing director with Ameriprise Financial Services, LLC. He is in his 30th year with Ameriprise, advising countless individuals, organizations, and business owners in the areas of financial planning, investment management, insurance, retirement planning, charitable giving, and legacy planning. Mr. Boston is a graduate of the United States Military Academy at West Point, New York, where he earned his Bachelor's of Science degree. His passion for investing and advising others was born while serving on active duty as a field artillery officer. As a financial advisor, he holds the Chartered Retirement Planning Counselor and Certified Long-Term Care designations, as well as the Series 7 and 24 securities licenses. Please welcome Private Wealth Advisor, James Boston.
Hello. Can everyone hear me today? Is that a yes?
Yes, we can.
All right, very good, very good. Just wanted to make sure I wasn't talking into the atmosphere here. Good morning, everyone. Great to see everyone and hear everyone. I'm excited about the presentation today. I hope to share with you a lot of information that's going to get you started on some of the investing basics, things you should know before you actually start investing. You know, as I was thinking about doing this presentation, I started to wonder, and as you mentioned, the 30 years I've been in this business, started to think about how long I've been in the business and why I originally got into this business. And the reason was I really felt that economics at the household level, as well as just the overall level, was what we needed to learn more about. Personal financial management is the key, I believe, to solving a lot of the issues facing our society right now. So I thought I could do my part by learning as much as I could and teaching others how to invest money and learn how to invest. At the end of the day, my primary role in this whole process is to help clients pursue their goals and dreams, no matter where you are, whether you're just starting out in life or getting close to retirement or you're already retired. That is the key to sharing information and getting to where you want to be. I want you to think for a few minutes about your different goals. Think about what you want for yourself now, what's most important to you. You likely have goals with a lot of different timelines, some that are for today, some for the short term, some for the long term. So take a few minutes to think about those things that you've dealt with in the past or you know you will have to deal with. Whatever those goals may be, understanding your financial basics is the first step to achieving them. So today, instead of simply explaining the basics to you, I'm going to share you a fictional story about Piper's finances. We'll use a fictional character today, Piper. In the next 30 minutes or so, I'm going to start by explaining some of Piper's understanding of the importance of goal setting and financial planning in general. Then we'll talk about Piper's budgeting, how she manages her debt and credit, how she saves, and then finally how she invests in order to achieve those goals. We'll take a close and quick discussion on overall good habits regarding your finances, and I'll answer any questions you may have at the end. Here's some of Piper's financial goals, and these are some very common goals that I see when I sit down and talk to people on a regular basis. And the first is to save more than I spend, and that's just another way of saying, how do I improve my discretionary income, the difference between what I make and what I spend, so I have more choice in what I do with my funds. The second goal is paying off all debt in a reasonable amount of time, while, and this is important, maintaining a good credit score. And I'll talk about the importance of that as well. Third goal, save for that next important event in your life. Those big ticket events, such as sending a child to college or saving for a home, those types of things are the big things. And then finally, building up wealth so that you can retire comfortably and maintain that comfortable retirement is the key. As I mentioned, Piper's first goal is to guarantee that she's saving more than she's spending. So how can she do this? First, she should start by knowing exactly how much she makes per month, as well as exactly how much she spends. Now, this might sound obvious to you, but knowing these numbers is really your financial foundation. I can't tell you the number of times when I sit down and meet with someone and they have no idea how much really is coming to the household and how much is really going out and where it's going. So my most successful clients are those that know exactly how much money is coming in and how much money is going out on the monthly basis. Now, once she knows the money that she's bringing in each month, she needs to account for those fixed things that have to happen. Things like rent, utilities, groceries, car payments, student loans. And she needs to make sure that before she spends money on any of those fun things that we want to do, she has enough to cover those essential expenses. Now, spending your money wisely, yeah, easier said than done. You know, when it comes down to a day-to-day basis of managing the money coming and going. But I find that about 25% of money that you make, your gross income, goes to taxes. So basically, we're planning for the remaining 75%. Of that, I recommend 20% should go towards your savings goals, saving for a wedding, house, retirement. Next, I recommend no more than 20% should go towards paying down debt if you have debt. And this includes everything from student loans, auto loans, mortgages. Now, in theory, that leaves 35% of your income for lifestyle expenses, but we know life doesn't break down just that easily. So let's talk a little bit more about these essential versus lifestyle expenses. Essentials are recurring expenses that support your basic needs. Some of Piper's essentials include housing, food, loan payments, insurance, healthcare, taxes, utility bills. She needs to know when these bills occur so she can pay them without any late fees also. That's another thing that eats away at our discretionary income, is paying late fees on bills that are due or credit cards. So you want to make sure that you know when they're due, and if at all possible, set them up on a recurring payment so that they pay automatically. Some of the lifestyle expenses include any expenses that may enhance your life. Those things would be things like hobbies, gifts, travel, salon, spa, housekeeping services. Now, Piper's decided to follow a 50-20-30 rule. And that means 50% of her take-home income, and that's that money after that 25% for taxes, goes to fixed costs, 20% goes to her financial goals, and 30% is kind of flexible for those things that come and go or may not happen every month or every quarter, and things that you want to do. She wants money left over at the end of each month, a profit or a budget surplus, if you will, so she can have money to save and invest for goals. Now, with that framework in mind, she has a way to keep track of how much she's spending while she's still enjoying her life. Let's move on to Piper's second goal, paying off all her debt in a reasonable amount of time and building and maintaining a healthy credit score. Now, currently she has debt from her education, car, credit card, common expenses that we hear and see all the time. Managing debt and credit may seem overwhelming, but here are 3 steps you can do to help achieve this goal. First of all, by using the budget she's established, she can calculate how much she should reasonably be spending each month on her student loans, car loan, and credit card debt. Her first priority is to pay down her credit card debt as fast as possible. Credit cards often have extremely high interest rates. So she'll be paying a premium or extra above what she's purchased if she holds on to that debt. Now, as we talked about earlier, her budgeting plan has no more than 50% of her take-home pay tied up in fixed expenses. So if those essentials take up 40% of her budget, she can direct the other 10% towards that credit card debt. So in other words, once you've taken care of your fixed expenses, if there's extra outside of the total amount you budgeted there, go ahead and pay a little extra towards your debt so you can get rid of that and not have that to worry about in the future. In an ideal scenario, Piper purchased a car that was within her budget, so she's not overpaying for a vehicle. So she can stay on plan to continue making those payments on time. Now, while she's paying down her credit card debt, she'll still be responsible for paying at least the minimum payment on her student loans. And once she's paid off her credit card, she can then reallocate that money, take what she was paying towards one thing and put it towards another. There are a number of great calculators online to help you manage debt. Just look up debt calculator, and those things can help you track input your particular debt and payment service and interest rates and track the best way for you to pay down your debt. As I mentioned before, one of the best practices is to put as many of your bills as you can on auto pay so you don't pay any late payments and credit cards. Now, let's talk about credit cards. Credit cards are a powerful tool. And all debt is not bad debt. So paying your bill on time also helps to ensure you don't get in over your head. So if you can't manage your monthly bills and you end up charging things on a credit card, you're kind of defeating the purpose of maintaining that budget. Also, when thinking about credit cards, think about credit cards that offer extra rewards that you can put towards trips or other luxuries. It's not uncommon for my wife and I to stay at least one night free when we go on a trip because we use a credit card that has the Hilton rewards, for example, and you choose your preferred hotel or airline built into the rewards program. So it's something you should also consider to allow you to still do some of those lifestyle things, those luxuries that we talked about. So in terms of managing credit, here are 3 things you should always do. Try first to pay off your amount you charge to your credit card in full each month. Consolidate your credit card, shop around. I have some clients that are really good at, once they have a credit card or a loan, they shop it around from time to time and see if they can find another one that offers no interest for 6 months, for example, so that they can roll that one that's charging them interest into something that gives them time to pay it off quicker. Also, check your annual credit score. There's a lot of apps now that allow you to download on your phone and check and monitor and manage your credit score. They often have really good tips on things you can do each and every day to make sure that you're managing your debt and managing your credit score. And it's a good idea. If nothing else, check your credit score at least once per year. Also, in this day and age of fraud, it's important that you make sure that you are looking for things that are not authorized expenses and charges on your credit card to protect your credit. Switching gears from credit, let's talk about debt. Now, I want to be clear that not all debt is bad debt, as I mentioned before, but some debt, such as mortgage or student loans, can be considered an investment in the future and the future of your kids. So it's important not to bite off more than you can chew. Now, how much is too much? The answer will differ for everyone a little bit, but one way to measure debt levels is to look at your debt to income ratio, or DTI. Now, to calculate your debt to income ratio, simply add up all your monthly bills, everything the outlay, outgoing money out of your household, rent, house payment, alimony, child support, student loans, auto, all those things, groceries, utilities, gas, and divide that total number by your gross, your total income, your before taxes monthly income. And the result of that number will be your DTI, your debt to income ratio. The lower the debt to income ratio, the less risky you are, as seen by lenders. Mortgages, car loans, now even apartments. When you're looking for apartments, they look at things like this. They're starting to collect more and more data, even when you're applying for an apartment. It used to be a very simple process of just filling out the application and then just doing a quick background check, see if you have anything from other apartment complexes. Now it's gotten almost as complicated as applying for a mortgage just to get into an apartment. So this is becoming more and more important for each and every one of us. Now, I don't like to apply a one-size-fits-all formula to determine desirable debt-to-income ratios, but these are some rough guidelines based on how the average lending company might evaluate your ratio. Excellent, good, borderline, and red flags. Another reason that Piper wants to manage her debt is that it also has effect on interest rates. Well, first of all, whether or not you'll get the credit or extended credit, and then it affects the interest rates you pay for that credit. So you can see how those two things can really impact your finances if, one, you can't get the credit you need, and two, if you're paying an exorbitant interest rate in order to secure that credit. Now, another one of Piper's goals was saving, preparing for the next big or unexpected life change. So what has she done to do that? Piper understands the importance of having cash reserves set aside for emergencies, such as the need for medical care, repairs, if her car breaks down. The size of this fund can vary based on your personal needs, but a good benchmark, kind of a rule of thumb, is 3 to 6 months of your living expenses. Piper's chosen 20% of her income to save each month, and you should absolutely have a chunk of money saved for emergencies, but also choose some specific goals to save for, like a vacation, a car, a boat, for example. And that's what's going to keep you excited about saving on a regular basis if you have something that's earmarked for. Now, the goal is to have cash reserve built up to provide a cushion against any interruptions and to prevent the need to tap into long-term investments for cash. So it's nothing like having to take care of a very short-term need, but then having to go borrow money out of your 401k or charge it on a high-interest credit card just for that very short-term thing. So by saving some money and having that 3 to 6 months of reserve set, you can make sure that you stay invested by not having to tap into the long-term things that you set aside for yourself. Speaking of long-term investments, let's take a look at Piper's fourth final goal, and that's to build her wealth. Now, how might she do this? You guessed it, by investing. Investing is different than saving because saving focuses on the short term and emergency funds. Investing is a way to grow your money and achieve those long-term goals. We're going to go over 3 steps in the investing crash course, with the first one simply being get invested. There are a lot of different ways to invest. The general categories of investing fall into 2 types of investments: stocks and bonds. And those are very general. There are a lot more categories to that, but this is usually where people start. Stocks being ownership in a company where you earn a return based on how well that company is doing. And bonds allow you to invest in a company or municipality with a guarantee you'll receive some kind of income or yield by loaning money to that corporation or the municipality. Many of you have heard about mutual funds, and these are portfolios put together and managed by a portfolio manager that usually have stocks, bonds, and other investing assets in them as well, depending on the goal of that particular mutual fund. Different types of investments may be more appropriate for different goals, but let's look at how starting now instead of waiting might have an impact on that outcome. One widely accepted practice is to start as early as possible and then stay invested. So to illustrate the need to invest, let's take a look at the potential cost of starting later and waiting and procrastinating on until you pay off debt, or the other excuses that I usually hear for why a person has not started investing yet. And the moral of this story is to motivate you to trade off a little more now in hope of earning a lot more later. This concept is known as the cost of waiting. Now, the cost of waiting is based on the concept of compounded earnings. When an investment generates earnings, those earnings are reinvested, and then those earnings that were reinvested generate more earnings. For example, let's take a look at Piper and her sister Penelope. Both earn the same rate of return, 8% over time, and their earnings are paid as dividends and are automatically reinvested to buy more shares of that particular mutual fund. And this example does not include any assessment for taxes. So Piper starts early. She invests $100 a month for 20 years and nothing more for the following 10 years. So the last 10 years of that 30-year period, she doesn't do anything. Her total outlay is $24,000. Penelope, on the other hand, starts later, but she saves more each month. She invests nothing for the first 10 years, but she invests twice the amount of Piper at $200 a month for the last 20 years. Her total investment is $48,000. Piper's total investment of $24,000 hypothetically grows to $131,614 based on that assumed interest rate. Now, remember, Penelope's getting the same rate of return as Piper, and she invested more money. However, her investment of $48,000 grows to $118,589. Penelope invested twice as much, ended up more than $13,000 behind. Save less and earn more. How could that possibly work? You guessed it, by getting invested in, allowing the combination of time and the compound earnings go to work for you. Another important benefit of a long time horizon is that it may improve your chances of recovering from the effects of markets day to day, up and down. So whenever you talk about getting into the market, we know the market and the value of your investments are going to fluctuate. So you want to be prepared for that. Over the long term, you may have a lot of down days, but hopefully you'll also have a lot of up days. And the idea is over time, the ups and downs potentially balance out and you actually have more up days than down. Step 2 in our crash course is diversify. Everyone talks about it. You've heard the term diversification. So it's important to take a look at what that means as it relates to your goals. Think of it like this. You buy a house with a big window overlooking a golf course. Fit your window with a single pane of glass and the whole window breaks if a golf ball hits it. But if you fit the window with multiple panes of glass rather than pay for an expensive large pane of glass, you'll have to replace just one small, relatively inexpensive pane. That's the point of diversification. When you have an appropriate mix of investments in your portfolio, chances are better your portfolio won't totally shatter when it's hit by a market downturn. Investments that do poorly may be balanced by the others that do relatively better. So in order for Piper to diversify in a way that is best for her, she has to understand her risk tolerance. So diversification has a number of things: investments, tax diversification, time diversification are all ways to diversify. Risk tolerance refers to the degree that you're willing to invest, recognizing the possibility that an investment may lose value or yield a little bit less income than it's anticipated to do so. Now, for example, if Piper's risk tolerance is more conservative, it might make sense for her to invest more heavily in cash or bonds, which are more income and considered more conservative. However, if her risk tolerance is more aggressive, she may want to have the majority of her investments in stocks. Typically, the further away from your retirement you are, the more aggressive you should be in your investments. Piper should also consider her loss tolerance. What potential losses would she be willing to sustain in a year? For example, Piper believes she'll be comfortable with her investments if they lose. And I say lose here, it's really not lost until you sell the investment. So I want to be clear about that. She's not really losing anything until she actually sells those shares. But here we're talking about loss in terms of the value going down on her statement until she decides to sell it. So she'll be comfortable if her investments lose 10% or less in a year. So if they lose 7%, she won't be emotionally thinking that she's going to cash out those investments. It won't cause her to want to get out of her investments. Now let's look at how diversification may affect the return on Piper's portfolio versus her sister Penelope's. Now, they both have $10,000 to invest, and they intend to stay invested for 25 years. Penelope puts the entire $10,000 into one hypothetical investment that earns a guaranteed return of 6%. Piper decides to diversify, investing $2,500 equally among 4 hypothetical investments. How did they fare 25 years later? Penelope ends up with $43,000, $42,919. But Piper did better. Even though one of those investments was a completely loss over the 25-year period, that particular investment went bankrupt or the company went out of business. The second investment returned about 4%, the third 8%, and the last one hit a home run, did 12% over the entire 25 years average. Overall, Piper's portfolio ended up at $64,000 by having a diversified portfolio that included investments riskier than her sisters, but also a couple that were less risky than her sisters. Moving on, the last step for Piper to take after she's invested and diversified her portfolio is to stay invested. And this is probably one of the most difficult to do, especially when the markets are fluctuating and the news on television is showing that the market's going down today, or geopolitical situations around the world are taken into effect. It's really difficult to keep the emotions out of investing. So here's a way to avoid having to think through that. Systematic investing, or dollar cost averaging, as it's commonly referred to, is the practice of putting the same amount of money in the same investment option consistently, regardless of where the market's going. You put the same amount of money in each and every month. Now, this can be beneficial in the long term because you're purchasing more shares when the prices are lower and fewer shares automatically when the prices rise. And so it tends to reduce the average cost of the shares you purchase. Now, on the screen, you'll see an example of this concept of dollar cost averaging. We've got two investors, Piper and her sister Penelope, who decided to purchase the same stock in company ABC. Penelope invests $500 in a lump sum, and on that day it was trading at a share price of $10 a share. While Piper, that was Penelope, Piper uses dollar cost averaging to invest $100 a month over 5 months. So she invests $100, usually the same day of the month. That money can be drafted out of your bank account and you automatically invest it in that particular investment for the first 5 months of the year, January through May. So how did they fare after 5 months? So as you can see, the dollar cost averaging method in this case resulted in a lower cost per share for Piper. You see her average cost per share down at the bottom is $9.15, and then on Penelope's case, it was $10 per share. The overall value ended up being 9% greater. Her actual return on investment and value at the end was 9% greater because of this one strategy of investing a little bit over time and take advantage of the fluctuations, as opposed to trying to time the market, which is another mistake investors make, trying to time the market and just invest consistently over the long term. So hopefully by now, Piper feels more confident that she can achieve her goals. And you do as well. Now that you know more about financial basics, there are a few other good habits to keep in mind moving forward. First, always have a plan for what you want and how you're going to get there. It's easy to have lofty goals, but it can be tricky to map out how you can achieve that goal. And it's really important to set specific goals. You want to make sure that your goal has both a dollar amount to it and a time frame for how you're going to get there and the time frame you want to get there. Second, remember that the earlier you start, the more time is on your side and the better the chances you'll reach your goal. Don't procrastinate. That cost of waiting is real. Next, don't let debt that you have get you defeated. This is another one of the big things that gets in the way, is spending so much energy on managing debt, paying penalties and fees associated with things we've already done that keeps us from having that extra dollar to put into the portfolio to grow for the long term. But you can mitigate that debt by being smart and about paying it off in a timely manner. Finally, know where you're spending your money. Once again, that dreaded B word, budget, is something that you have to know on an ongoing basis. Sit down, put it on a spreadsheet, and make sure that you know exactly how much money is coming in, and how much money is going out. Addressing the credit card, as I think about that, just the credit card and debt, make sure you're not spending or charging more than 20% on your credit cards, and try to pay that 20% off each month. Another thing with the credit bureaus, you can find out exactly when your credit card company reports to the credit bureaus. So that if you have an opportunity to pay down that balance right before they report to the credit bureaus, you can have a positive impact on your credit reporting score. So take a look at those two things as it pertains to managing your debt. So in summary, we've gone over the importance of goal setting and budgeting and managing debt and credit, saving and investing as some of the key components to successfully managing your finances. I want to thank you guys for having me as a guest speaker on your call today. And let me start with answering a general question. And that is, the most common question I get asked is, so what now? We've all been to those presentations where we attend, we get a lot of good information or a good start, but we're not quite sure what the next step will be. And my advice is consult with someone. Sit down and talk with the financial advisor. I know it feels like you got to bare your soul to them financially speaking, and let them know exactly where you are. and come with some very clearly defined goals that you want to accomplish so that that person can do that. Offer a complimentary initial consultation. Be glad to sit down and talk with you either by phone, virtual, or however you choose in person to sit down and talk about your goals. Thanks again.
Thank you so much, Mr. Boston, for that wonderful and informative presentation. The webinar is now open for Q&A. We have just a few questions for you to answer from our attendees. Question: how can those who have mid to low range salaries start investing?
Oh, that's a great question. As I mentioned, sometimes it feels like there's not enough money to actually think about investing. And I think by using that rule of thumb of setting aside how much needs to go towards the fixed expenses, how much you need to save to reach your goals, will help you to kind of start on a small basis. But the main thing is just start. Everyone has $100, maybe even $200 a month available to start putting aside for the long term, and also for that cash reserve to keep you from investing. So that's the key. The key is to sit down, talk to someone about your goals, and just start very small. And then as you get comfortable, you'll be able to save more.
Question: what criteria should be used when selecting a well-qualified, trustworthy investor or investment firm?
Oh, that's another great question. There are so many firms out there. There are so many different types of investment advisors, some that are more insurance based, some that are more brokerage based, some that are comprehensive financial advisors, such as myself. One resource I'd like to point you to do a little background investigating on a particular investment advisor is FINRA. That's our governing body. The website to go check is brokercheck.finra.org. brokercheck.finra.org. And there you can put in the name of the financial advisor that you're looking to hire or looking to consult with and see what their background is. In terms of companies, do your research there as well. Compare different companies that do investment management, look at the reviews, look at the ratings of those companies, and you'll see that as mandated by our governing bodies at the bottom of the website. And do your research there as well. You want someone obviously that's reputable, someone who's been around a while, someone who knows what they're doing and has been doing it for a long time.
Question: what is the best type of investing for individuals who are 10 to 15 years from retirement?
10 to 15 years is still considered long-term in our industry. Usually when I think of immediate term, I'm thinking in less than 12 months. And that's something you certainly shouldn't put money in the stock market if you're going to need the money in less than 12 months. The next phase would be short term, which would be 3 to 7 years or so. I consider that still, up to 3 years. 3 to 7 years kind of be the intermediate term. And then long-term be anything over 7 years. So 10 to 15 years is still plenty of time for you to invest money for whatever's going to happen in the market during its normal up and down cycles that it always goes through to take place. And you should still come out positive on the other end, as long as you've chosen investments and you've continued to monitor your investments that you've chosen for that long term.
Question: is it too late to invest after retirement?
It's never too late to invest, but you have to have an idea of what are you investing for at that point. If you're investing for more income for yourself, that would guide you towards one type of investment. If you're investing to continue to build wealth to transfer to the next generation, that's another type of investing. I have clients on a regular basis that invest as aggressively after they're retired as they did when they were young, because they want to still build that portfolio to transfer to their heirs. They want their heirs to get a better start in finances than they did. So that's a really good question.
Question. Someone wants you to spell out the website, please, that you
Sure.
mentioned earlier.
Sure. The website is www.brokercheck. That's one word, BROKERCHECK .finra, FINRA.org. brokercheck.finra.org. And you can also just go to www.finra.org, and you should see the broker check tab at the top of the page also.
Okay, thank you so much. Those are all the questions that we have for today, but please feel free to reach out directly to Mr. Boston for further questions and information regarding investments. Thank you so much.
Thank you.
Thank you again for your participation in today's event in support of Financial Literacy Month. I would like to especially thank today's guest speaker, Mr. James Boston, members of the Program and Planning and Development Committee, Economic Development Subcommittee, and the Technology Committee. The Suburban Houston Fort Bend Alumni Chapter is committed to servicing our community through personal development, financial literacy, health and wellness, education, and scholarships. We encourage you to follow us on social media to stay informed of the upcoming event dates and on ways you can support our programs and scholarship initiatives. This concludes today's event. We will also, for those who registered, we will be sending you a follow-up email in order to get feedback on today's webinar. Everyone have a wonderful week. Until next time.